Are we in a recession or are we not in a recession for the United States? Is one coming to the USA? Or can the Fed actually pull off a soft landing after all? It's the question we'd all love a damn answer to, because if the USA does hit a recession officially, then the knock-on effects for markets could be pretty damn bad. So let's see what the data is telling us. First, what are the central banks saying? Take it all with a grain of salt, of course, can't really trust central banks, but what they're saying right now is that we are actually past using the technical definition of a recession, because, you know, the usual tradition of 2 negative quarters of GDP equals a recession just doesn't fit the narrative anymore. That would have meant, by the way, that the recession has already been and gone during 2022, because the first 2 quarters of 2022 were negative. The last 2 quarters were positive. And according to the Federal Reserve, we're still not in a recession, and that didn't equal a recession when it happened. U.S. Treasury Secretary Janet Yellen has recently said you don't have a recession when you have 500,000 jobs and the lowest unemployment rate in more than 50 years. And it's not just the USA, by the way. The EU is also painting a rather rose-tinted glass narrative for their economy. The European Commission has come out and said in its latest forecast that the European Union's economy is set to narrowly avoid a much dreaded recession this year, as inflation eases and, of course, as gas prices continue their steep drop, assuming no more crazy happens in markets, right? But it still seems everyone is expecting a recession to happen, except for the central banks. Americans seem to have mostly a negative view, negative expectations for the US economy over the first half of 2023. They're expecting inflation and interest rates to keep rising, in spite of the fact that inflation's falling and interest rate hikes seem to be nearing an end. So are the bankers right, or are the people right? And most of this course is probably going to come down to the job numbers, because despite high inflation, the strong job numbers and positive economic growth quarter on quarter could actually be what avoids the US slipping into an official recession. By the way, I want to know your opinion on this, so do let me know if you think the USA is going to hit an official recession or not. Hit me up down below in the comment section with your opinion on that question. So how likely is a recession? Well, even though earnings have been pretty damn strong so far this season, a few hits and misses of course, but it may only be a matter of time before we actually start getting really squeezed on corporate earnings, and a recession of course then sets in. But maybe they don't get squeezed, not now anyway. They'll always get squeezed at some point. Maybe now is not the time for it. The big recessionary indicator, of course, that most investors tend to look at is the yield curve. Now, a yield curve inversion has happened before every recession since 1950, which means it predicted the past 7 recessions in the USA. The yield curve inversion is when short-term bonds pay higher interest than long-term bonds. That's not how it should be. Usually, the longer the duration of the bond, the more risk there is, and thus, therefore, investors are compensated for that risk with a higher rate of return. An inversion, particularly between the 2-year Treasury and the 10-year Treasury, is the canary in the coal mine. It is the one that investors always pay close attention to. And right now, we are seeing the biggest inversion of this yield curve in 40 years. If you take out a 1-year Treasury bill, you can actually now earn 5% on your money. Not bad, right? Last time this happened, by the way, was back in 2007, right before the big crash. Will history repeat this time, or is this time different? Guess we're gonna find out. Then there is new housing construction in the USA, also getting hit pretty damn hard, marking a 31-month low in January and down 21% in the last year. This tends to be a leading recessionary indicator outside of the employment numbers. It is also a result, of course, of higher interest rates, making housing less affordable for new buyers and less financially attractive for speculators. Then, of course, we also have the Philadelphia Fed Manufacturing Index, which has moved down to -24, the lowest level since May 2020. This is a monthly survey by the Federal Reserve Bank of Philadelphia, which goes out and questions different manufacturers on business conditions and how things are going. Since 1968, the current levels have indicated the US economy was either in or approaching a recession. While the Federal Reserve is making it appear that the labor market is thriving and doing so awesome, there is, of course, a different side to that narrative. You see, unemployment is usually like the last shoe to drop before a recession comes in. We could be getting closer to this happening. We are seeing spikes in US job cuts, just like we saw in 2000, 2008, and 2020, again, pointing to the potential for a recession to come in. Raoul Pal says it is the rate of change that really matters here. It looks like banks are potentially preparing for a recession too by boosting aggregate limits on credit cards to a record $4.4 trillion, up $88 billion in Q4 2022. But if we look at this chart here, analyzing 7 US economic indicators, it shows we're not quite in that recessionary phase just yet, but we certainly could be getting a lot closer, as this chart shows. It shows the yield curve, business confidence, and the OECD leading indicators are all basically in the toilet right now. Industrial production is getting worse, but financial conditions, as well as consumer confidence and employment, are all still being reported as being pretty strong. Now, for a recession to be deemed official, it means more pain will be needed in order for these final few areas of the economy to capitulate. And in terms of how much longer the Fed can go with their interest rate hikes in order to cause that pain, well, a move in the December 2023 funds rate means a pivot is no longer priced into the markets. The market is now pricing in ending the year at the Fed's target of 5 to 5.25%, which means that the market is pricing in more than what the Fed is currently communicating. So there's that to take into account. Now, before we talk about what all of that data means and what a recession would actually mean for markets, just a quick reminder that every single week my team and I publish the Wealth Mastery Investor Report. This is a crypto newsletter, comes straight to your inbox. We talk about altcoins, NFTs, airdrops, market analysis, and much more. Join our over 50,000 weekly readers by signing up for free using the link down below in the description. Okay, so that data we just discussed, what's it all mean? Well, essentially, we have a lot of conflicting data right now. We have some very solid indicators like the yield curve, which is saying that a recession is coming, but not everything is aligned. Although there is still time for things to get in line, obviously. The big question, I suppose, is can the Fed pull off their magic trick and get their soft landing after all? Or perhaps the real equation that not nearly enough people are actually considering or talking about or even willing to admit, does the Fed even lead global liquidity markets anymore? Remember, since 2009, China has been driving the business cycle, and China has also been injecting truck tons of money into markets in recent weeks. In fact, global liquidity likely bottomed in November. Since then, China and Japan in particular have been injecting trillions, more money than the Fed and the UK and the EU have actually been taking out of global markets. The USA may just, in fact, end up narrowly avoiding a recession, and a change in monetary policies from the Federal Reserve would definitely be a big lift to markets when it actually happens, assuming that it doesn't happen during the recession, right? But if the jobs data doesn't matter and the Fed rate hikes don't break the economy and the economy stops expanding as it has been doing for the last 2 quarters, and if the Chinese and the Japanese monetary injections are simply not enough to boost global markets and to bring inflation down, then what happens to markets if the USA does officially declare that they are in a recession? Well, first keep in mind that rising interest rates, they actually take several months to filter down into the economy, making recessions pretty damn hard to call in real time. And remember too, that recessions are usually declared after the fact, right? A recession can either mean one of 2 outcomes for markets. 1, markets finally bottom after a recession is declared. We get our brutal capitulation sell-off. Or 2, markets front-run the recession. We break the models that have informed many a clever person's way of trying to understand and predict what's happening in markets. Also keep in mind that Bitcoin has never experienced a long recession before. Remember, it was built in the wake of the 2008 financial crisis, came afterwards. But if we look at gold, it usually does well in a recessionary situation as a store of value. The question then becomes, can Bitcoin finally get the store of value narrative back on track? Or will Bitcoin continue basically just to be a slave to its correlation to major stock indexes like the S&P 500 and the NASDAQ 100? Because if it does, then the bottom in that situation may not be in for Bitcoin if stock indexes go lower, in spite of basically every on-chain and technical indicator saying that the bottom was likely in November and that we are probably going higher in 2023. Also, there is the chance for Bitcoin to just go on a run of its own, do its own thing. With the Bitcoin halving coming up in May 2024, Bitcoin could in theory do very, very well in the run up to that event. Macro economist Lynn Alden is expecting gold and Bitcoin to outperform the market as we remain in an overall inflationary period over the long term for markets. She says they will give you upside in an inflationary type of environment. Remember, once we get high inflation, things just kind of mellow out there. It's okay. High rates, people, it's predictability, right? But she does warn that Bitcoin is Fed dependent in the meantime, saying, I do think this is a deep value accumulation zone for Bitcoin with a 3 to 5 year view. But traders should be aware of the liquidity risks in the second half of 2023. Also, keep in mind that the housing market has seen sales fall at an ever faster pace than during even the great financial crisis of 2008. So that's definitely something to be aware of and how all these things are going. We've even seen Blackstone limit withdrawals from its funds to slow the bleeding in property markets. But with mortgage rates starting to come down, this may not be the mother of all crashes that you might expect to see. Remember, fear is always at its greatest and panic at its greatest near bottoms, right? And as for the stock market, history shows the S&P 500 bottoms after, not before, a recession starts. If that happens, then new crypto lows would be coming. Either earnings are set to get worse as the recession sets in and the stock market falls, or this is a new bull market, the recession's not going to come and we continue up from here. So it depends on how you want to interpret the data. Okay, that's it. Subscribe now. See you next time.